The U.S. Federal Reserve is laying out, well, a first time a plan for more normal management of the U.S. monetary policy. But Fed Chair Yellen says that ultra-low interest rates are still expected to stay in place for a considerable time. Washington correspondent Daniel Ryntjes has more on this.
Unless there's a dramatic change in the economic outlook over the next month, we can now expect the US Federal Reserve to stop its unconventional practice of buying mortgage-backed securities and treasury bonds by November. And Federal Reserve Chair Janet Yellen is talking more explicitly about returning monetary policy back to normal.
Since the crisis, the Federal Reserve has been providing extraordinary accommodation using non-traditional tools of monetary policy. The FOMC's intention has always been to return to a more traditional approach. And throughout this period, the committee has been preparing for the normalization process.
The main traditional approach she's referring to is the setting of the federal funds rate, the rate financial institutions lend to each other. This influences interest rates across the economy. But the Fed is not adjusting the language it uses to describe when that rate will rise above its current level of between 0 and 0.25%.
The committee reaffirmed its forward guidance that it likely will be appropriate to maintain the current target range for the federal funds rate for a considerable time after the asset purchase program ends.
Following its latest two-day meeting, the Federal Open Market Committees indicated that current growth levels are steadily improving, which should help continue to bring Americans back into the workforce. But its growth projections do not indicate any major burst of economic activity ahead, and it expects inflation to remain low. So though the Fed is now considering the normalization of monetary policy, the majority of committee members are still very cautious about raising interest rates too quickly. And they're indicating that the very first rate hike will probably begin sometime next year. Daniel Ryntjes, CCTV, Washington.
There was other economic news as well. U.S. consumer prices fell for the first time in more than a year. Food and housing costs are up, but an across-the-board drop in energy prices drove the CPI inflation index lower for the month of August. This latest data could renew central bankers' concerns that inflation is running actually too low. Meanwhile, a new survey of American home builders puts confidence at a 9-year high. But there was a dim spot in the latest round of economic reports. Hourly earnings ticked up last month, but wages have risen less than 0.5% over the past year.